Over the last few weeks, I've been getting questions from my clients about whether now is a good time to be investing in the stock market. Inflation is high and it looks like we're headed for a recession. If the markets are going to fall, then why don't we just wait until it does and then invest when the outlook improves? This sounds like a rational idea. And when I first started working in investment management, I used to ask these types of questions. If we know that X is coming, then why aren't we doing Y to protect ourselves? Well, I now no longer ask these questions, and by the end of this video, neither will you. Hello and welcome back to the channel. If you're new here, hi, my name is James. I am a financial planner, and this is a place where you can learn to make smarter financial decisions. As humans, we take great pride in our ability to make sense of the world around us. We are innately curious, which drives us to want to understand how different systems work. Now, most systems we encounter in life have very clear inputs and outputs. Take a simple pulley system as an example. We can all see that if we were to pull down on this rope with enough force, the weight would rise. It's a clear cause and effect. If we do X, Y happens. These are the types of systems that we are used to in everyday life and in our careers, which is why when we're faced with something that does not work as we would expect, we get ourselves into a lot of trouble. Take a Formula One car, for instance. You would think that the faster it goes around a corner, the higher its chances are of spinning off the track. That's what our intuition would lead you to think. But actually, the car needs to go fast around the bend to generate enough downforce to keep it sticking to the track. This other variable, downforce, that we would have not immediately considered resulted in a totally different outcome than we would have expected. And as systems like this get more complicated and have more variables, they become much harder for us to understand and to predict. The weather system. The number of variables involved with the weather are too hard for the human brain to comprehend, so much so that we have to use computer models to help us predict it. Even with this, it's very hard to do, but we're certainly much better at predicting the weather than we are at predicting what the stock market will do. Yes, there are arguably a hell of a lot more variables that go into stock prices than there are the weather, but what makes the stock market so hard to predict is that the way its rules are applied change all the time. Let me explain. With a weather system, despite its complexities, there are known rules that we can use to predict events. When, for instance, a warm front comes in from over the sea and over land, the air gets pushed up over a dew point and we could expect rain. There are, of course, a lot of other variables to consider, but we can determine how each of them are likely to interact with each other and build a model around it. The stock market, however, has an entirely different dimension to it because the stock market is much more like a game. Think about tennis, for instance. Wimbledon is on at the moment, and we may, if we're lucky, end up seeing Nadal and Djokovic in the final. The rules of tennis are constant, and the tactics used to win are well known. But what makes tennis so hard to predict is that each player is constantly trying to anticipate what the other player is likely to do. Nadal often likes to sit at the back of the court and grind down his opponents with aggressive ground strokes. Djokovic knows this, so he's going to want to try and win points quickly with strong serves and returns. But Nadal also knows this, so he knows he's going to have to try and be on the defensive. But Djokovic knows that that is how he's likely to react, so he is likely to switch up his game and try a different tactic. It is a dance of infinite possibilities, which makes it so hard to predict. And the same thing goes for any game or system where humans are interacting with each other, trying to guess what the other person is likely to do. The infinite number of outcomes adds a sense of randomness that we cannot predict. And the stock market is like this, but on steroids. With stocks, not only are there an infinite number of variables that can influence prices, but the patterns that we observe today are often gone tomorrow. As an example, imagine that we'd noticed that between February and March, stock prices tended to rise. And we think that, okay, this makes sense because this is the time of year that a lot of people get paid their bonuses and they're clearly investing in the stock market. So next January, we decide to start buying stocks in anticipation of the market rising during the next bonus cycle. but it doesn't appear. Why? Because if there was a clear pattern, you won't have been the only one to spot it, and there would have been lots of other people buying at the same time, potentially even before you, which would cause stocks to rise in January or potentially even before that, which would in turn eliminate the pattern. Or maybe the rise in the stock market had nothing to do with bonuses at all. Maybe it coincided with the lifting of some pandemic restriction, or maybe it was because Biden announced some new stimulus. Correlation does not imply causation. So I hope you're starting to see that when it comes to the stock market, despite whatever patterns we may have observed in the past, it's very hard for us to say with any level of certainty that one series of events is going to result in any particular outcome. X very rarely equals Y. And the second thing that you always need to remember about the stock market is that it is forwards looking and already considering all of the things that could potentially happen in the future. Think back to a time that you've been following a stock, and in its annual earnings report, it announces that it has grown its revenue substantially. But for some reason, the stock price has fallen on this news. Last October, Apple announced that it had grown its revenues by 30% year on year, but the stock price fell. Why? Because the market was expecting it to do better. Of course, if it looks like Apple is going to grow its revenues by 40% next year, its stock price will already have risen to reflect that. If, however, it misses those expectations, it will fall. So if you're sitting there thinking, I reckon Apple is going to grow its revenues next year, therefore I'm going to buy Apple stock, come on, everybody already knows that. It's already reflected in the price. So what you really need to be trying to work out is whether Apple's revenues are likely to grow faster than what the market is already anticipating. Stock prices represent what we collectively as stock market investors think will happen in the future. Is the stock market always good at predicting what will happen in the future? No. But is it better than you? Yes, most likely. And there's a good reason for this. It's called collective intelligence, or the wisdom of crowds. I'm sure you'll remember the game, Guess How Many Sweets There Are in the Jar. Well, in 1987, Jack Trainer, the financial professor, played this game with his students. The jar held 850 sweets, and the students' guesses ranged from 1,560 to 410. Absolutely terrible. But the average of all of their guesses was 871. And of all the 58 students, only one person managed to guess closer. This phenomenon, where the collective guess is almost always the most accurate, is extremely well documented and consistent across all domains. Studies involving farmers at livestock markets show that their collective guess of the weight of a cow are far more accurate and consistent than any individuals, no matter the individual's experience. Who Wants to Be a Millionaire? Remember that game? Well, the Phone a Friend lifeline, where you can call up your most intelligent friend that you think is likely to know the answer to this particular question, typically only gets the answer right 65% of the time. Whereas when you ask the audience, they get it right 91% of the time. The prices that the stock market arrives at is the collective guess of what we think will happen in the future. So you have two options. You can either buy into that collective intelligence very, very cheaply by buying into an index fund, or you can pit your wits against it and try to time the markets. But if you do, you should know that the odds will not be in your favor. So let's think about this in the context of today's environment. Inflation is really, really high, and it looks like there's a high chance that we're going to go into a recession. I know this, you know this, everybody knows this. So we should expect that these eventualities are already priced into the markets. Imagine, for simplicity's sake, that there are three possible future scenarios. Number one, inflation starts to show signs of slowing on its own. So the Fed decides to stop raising rates as quickly as the market was expecting, and stocks rebound. Number two, inflation falls, but only after the Fed has raised rates to 6%, inducing a recession for 2 years. Number 3, inflation turns out to be impossible to tame and we see stagflation for the next 10 years. These are potential risks and outcomes that we are all aware of. So the market will be weighing each of these in terms of the probability of each of them occurring and the effects that they might have on the stock market to arrive at a price that collectively reflects what is likely to happen in the future. Will the markets be absolutely correct? No, of course they won't. There's still a chance that we could end up with scenario 1 or scenario 3. But what's more likely to happen is that it's going to be somewhere in between, but not exactly what the market was anticipating. But the chances are that the market is going to be much better at predicting what is going to happen than you are. So this is the thing. If you are sitting there thinking that you want to sell, or maybe you are delaying making investments that you had originally planned to make, you are suggesting that the market is wrong and that you are right. Now, firstly, the chances of that are low. And secondly, you don't even know what the markets are pricing in. Maybe the market is expecting something much worse than you are. If inflation goes up to 10%, I don't know, maybe stocks will rise because the markets were expecting worse. And thirdly, you cannot make X equals Y assumptions. An example of this might be assuming that a recession will be bad for stocks. Maybe it will be. Or maybe the US goes into a recession very quickly. Demand for goods and services drops, creating disinflation, and the Fed then has to U-turn and start reducing interest rates, which could cause stocks to bounce. I'm not saying that this will happen or even that it could. I'm just playing devil's advocate here to remind you that we are dealing with one of the most complex systems in the world, where you can never say for certain that one thing will result in another. So, what are the takeaways from all of this? Firstly, the stock market is already pricing in every risk you are reading in the newspapers. Will it be correct? No. Will it be more accurate than you? Yes. So you need to stop worrying about things that you cannot control and focus on the things that you can. Things like diversification. Everything that I've just said only applies if you have a well-diversified portfolio that invests in thousands of businesses from across the globe, ideally through low-cost index funds. Risk. If the markets are stressing you out, perhaps you are taking more risk than you can handle. If so, perhaps you should think about reducing the risk of your portfolio. Cash flow. At the end of the day, who cares about stock market volatility if you don't need the money? And you are entirely in control of making sure that you have enough money on hand to fund your expenses. If you're still working, you should have an emergency fund of cash of between 3 and 9 months worth of expenditure, which you can dip into if you really need to. Whereas if you're retired, then you should know exactly where your income for the next 3 to 5 years is going to come from. And this should be held in either cash or short-term government bonds. Now, this time last year, we were in a very different scenario where stock markets were at all-time highs. And I know because of some polls that I ran then, a lot of you were holding on to cash in anticipation of a stock market crash. So I made a video that investigated that to see whether that was a genius idea or a fatal mistake. Now, a year on, there has been a crash, but we are pretty much back to exactly the level that we were this time last year, which makes this video absolutely fascinating to watch. I'll see you there.